Hello, this is Joe Pryor, the virtual real estate team in Oklahoma, where we specialize in residential investment in the Oklahoma City and the Tulsa markets. I've been gone a little while. We've had a nice extended vacation, but I am back. And the Fed Open Market Committee has met this week, and there was a 25 basis point cut. Now, the government is shut down, and so there hasn't been the economic data that they normally would have to make this decision. So they're flying a little bit blind. But the two things that we've seen is, number one, inflation is sticky. In other words, it's about 3%. That's over the Fed's target of 2%. Now, if you've been to the store to buy, the supermarket, you understand. I know I see $14 eggs. If you want the best eggs, I see the honey that I buy that used to be $6 is $10. Meat, if you eat red meat, it's a little crazy right now. So a lot of things are stuck, but at the same time, growth is at a standstill. And so what the Fed is really worried about is something called stagflation. This is when inflation can't come back. It keeps kind of going up. Tariffs are going to be affecting this, of course, throughout the next 6 months to a year. And at the same time, growth is minimal or zero. And this is not a good place to be. And so the Fed decided to go ahead and cut 25 basis points. Now, everybody expects that when the Fed does that, that mortgage rates go down. And that's not automatic, because this is the Fed funds rate. This is a borrowing rate. It's not mortgage-backed securities. And so, for instance, the 10-year Treasury, which was down a little bit below 4% right before the Fed announced, when it went down 25 basis point, it actually went up to about 4.1%. So this often happens. Now, there's an indirect correlation between the 10-year Treasury and a mortgage-backed security for a 30-year mortgage. It more affects the points that they may charge to bring the interest rate down that you might pay. So it isn't automatic, and that's what happened. There was a slight uptick in interest rates. Now, the next big time for the Fed Open Market Committee to meet is in December. Now, high expectations are for the Fed to reduce rates again in December. Now, hopefully the government's going to be open by, the time that maybe you see this video, or maybe shortly after that. Economic data can flow again. Hopefully inflation, which has been sticky, is not going to be the same way in December, but there's expectations the Fed's going to lower and lower again in 2026. So rates are not bad right now. I mean, compared to what they used to be, for instance, that 10-year Treasury we talked about was almost 4.9% in January of this year. In October, it's 4.1 or even a little bit less. And so you can see that rates overall have gotten better, but we're going to have to wait and see what the Fed does. Now, in the next video, the thing that I'm going to talk about is what builders are doing about this. So in other words, regardless of Fed funds rate, regardless of what you see in terms of interest rates, I'm going to show you how builders can beat this system and give you much, much lower rates, especially in the fourth quarter when they really need you. So stay tuned for the next video. We're going to talk about deals.